Good day. My name is Luke McMahon, Portfolio Manager at Glacier Invest. And today I'm just going to give you a brief feedback on the recent portfolio changes made to the Jenwil Blue Star wraps as a result of our review done for Q2 2023. I'm just going to be sharing my screen with you quickly just so I can take you through some of the slides. Okay. To start off, we'll begin with some market overview performance. And then just to give you some context as to what's happened in markets. Thereafter, we'll look at some of our asset allocation views going forward, and then followed by the recent changes made to the portfolios. Righto. In terms of performance, if we just have a review of what the various asset classes have done, we can see that as a starting point, SA equity has done fairly well relative year to date, up almost 6%. If you recall, last year, the JSE equity market was up roughly around 3.8%. So good to see some risk on activity in equity markets, that being both local and offshore, where we see some decent returns. You will notice there was a bit of a drag on the overall JSE equity market, local equities, in terms of resources dragging, roughly around down minus 10.51%. That's largely due to the softening of commodity prices. We know that demand for commodities has dampened quite a bit, especially given the lackluster recovery in the economic growth in China after their hard lockdown. That's had some negative pressure on prices of your base metals and also some of your precious metals. And as a result, some of the resource stocks on our equity market has underperformed. You will notice also that there's been quite a big style shift in terms of growth as an investing style outperforming value year to date. That's largely due to tech stocks really coming back in vogue this year. A couple of factors have driven the strong performance in growth stocks, both local and offshore. And that's largely due to the fact that the market's anticipating that we are nearing an end to this interest rate hiking cycle, and the forward guidance is that central banks next year will be looking to potentially cut interest rates, and growth and an investing style tends to do well in an environment where interest rates get cut. You will see that value as an investing style has underperformed slightly, and that's largely due to the cyclical nature of the stocks underpinning value as an investing style, that being your resources sector and then also financials. We can see that value has underperformed growth quite materially since the beginning of this year. As an asset class, listed property has underperformed the overall equity market by almost 10% or more. We know that in an environment where economic growth is fairly slow and also higher interest rates are prevalent, we know that the listed property market comes under pressure in that kind of environment. In addition, in the South African context, we do see that load shedding also continues to be a negative impact for that sector, and that's really weighing on the returns of the overall listed property sector in South Africa. From a fixed income perspective, we can see over the quarter, especially that volatility that was seen in May month when that Russian ship, the Lady R, touched the harbors of South Africa. That really caused quite a lot of volatility in our fixed income market, and we saw a sell-off of SA government bonds over the quarter. We did see a strong recovery in June and then subsequently also in July in South African fixed income once things started to normalize. We know that bonds at the moment are still offering you some relatively strong real yields, even though it's pushed up quite a bit and come in over the last month or two. We do still see some attractive returns for SA government bonds running forward, especially given South African inflation is only at 5.4%. The running yield on most of the fixed income assets from short end to the long end is well in excess of inflation, so giving you some real returns. If we move on to the offshore space, and I guess one of the big talking points around offshore for South African investors has been the volatility of the rand against the dollar. That has materially assisted the returns that we've seen from some of the global asset classes, particularly equities. We see that developed market equity has done just under 30%, about 27.78% in rand terms over the 2-month period or 2-quarter period from the beginning of this year, largely driven by growth. Once again, those tech stocks coming into play, and then also outperforming the value index quite materially by about 26%. Emerging market equity has lagged developed market equity quite materially by more than 11%. And that's largely due to the lackluster performance of the Chinese equity market, which makes up quite a large exposure of that emerging market index. Just to illustrate the volatility of the rand, you can see it's been quite volatile this year. And you can see that the rand has been oversold quite materially, which is not the normal circumstances for where our rand currently trades. If we look at purchasing power parity or fair value of the rand should probably be trading under 16 rand to the dollar if we look at it from inflation differentials between South Africa and the US. We can see that we've had a benefit of that for our offshore exposure within our portfolios. We have, over the last quarter or two, taken some offshore exposure off the table, given that we've seen some tremendous returns. We've banked some of that profits, and we've actually bought some a little bit more local fixed income, which was a lot more cheaper in that volatile period in May month of this year. Just in terms of some of the factors driving our overall asset allocation view, we can see that it's been a story about interest rates and where interest rates are going. This has driven quite a lot of the sentiment in the market. Once again, I mentioned that the market's been forward-looking that potentially interest rates are going to be cut over the next 6 to 12 months, particularly in the US. And that would necessarily have a positive impact for both bonds and risk assets in that environment. It's partly why we've seen a risk-on rally year to date, especially in global equities. We have seen that inflation has started to tick down quite nicely, especially nominal inflation in the US and also in Europe. However, core inflation remains a little bit sticky. That's largely due to homeowners' equivalent rent or shelter being quite a large component of core inflation, still remaining quite sticky. But the trajectory overall is that inflation is coming down in line with what central banks have anticipated, given their mechanisms to raise interest rates to try and curb inflation. One of the other strong themes, as I mentioned, has been the performance of growth tech stocks. We can see that since the beginning of the year, the growth tech stocks, mainly the Magnificent Seven, as they now dubbed, has done fairly well, that being Microsoft, Amazon, Apple, Google, Meta, Tesla, and NVIDIA. They've driven quite a large portion of the returns of the overall S&P 500. We can see that those 7 stocks alone attributed about 44% return as a subset. As if you look at the rest of the market, it's been lackluster performance. The other 493 companies in the S&P 500 up until that, the end of May gave you roughly around 1%. The double-digit return seen in the S&P 500 has largely been driven by those 7 stocks. As a result of that strong performance seen in US tech stocks, we now see that US equity is relatively overvalued. If we look at this particular graph on the left-hand side, it's showing that over the long-term trend of where the price-earnings ratio is for US equity, the current positioning or current levels are overbought, so it's effectively expensive. Where we are seeing some pockets of valuation available on offer, where there's a more attractive valuation on offer. It's in Japanese equity, European equity, and also in Chinese equity. You can see all of them trading well below their long-term averages. If we look at SA equity at the moment, it's relatively cheap if we just look at it on a forward PE perspective. This particular graph on the left-hand side is showing you the impact of the currency, the rand depreciation, which is really a strong beneficiary for rand-edged stocks, which are a large component of the South African equity market. That's partly why you see the earnings per share growth shoot up like that, but that is not a normal environment, given the fact that the rand has blown out quite materially over there. That has started to normalize quite a bit, and that that earnings per share figure has come in quite materially over the last month or so. Like I said, SA equity is relatively cheap over its long-term average. It's one of the areas where we are seeing a large margin of safety. If we look at the tactical asset allocation view going forward, SA equity is looking fairly attractive on a valuation perspective, but there are quite a bit of local domestic risks, which could still play out, that being load shedding, slower GDP growth, high unemployment, and the likes, and really having a negative impact on the potential returns that you could see from SA domestic focused equities. Nonetheless, we're neutral on equity at the moment, SA equity, given that there's also heightened risks of a recession that could potentially play out next year. The 6 to 12-month view is to be more cautious on local equity and underweight that slightly. SA government bonds, we still quite constructive on that. We're neutral on SA government bonds in both the short term and the longer term. Still double-digit returns in terms of what we anticipate for that asset class going forward. SA listed property, it's an asset class that we still want to be underweight. The return expectation for this really is well under inflation. So in this opinion, it's to be underweight both short and long term in that asset class. What we are seeing a little bit more in terms of attractive valuation is in SA short-dated fixed income, more so your money market and your 1 to 2 year, 3 year government paper. You can actually see that you're getting relatively decent returns from cash, which is beating inflation without necessarily taking on undue risk. It's the reason why we overweight local fixed income, short-dated fixed income in this asset allocation table. When it moves to the offshore space, we currently neutral on both developed and emerging market equity as well as global bonds. The 6 to 12-month view, as we potentially see a recession play out next year, we are of the opinion to be underweight equities, so be a little bit more cautious and risk off in that environment. So that's the 6 to 12-month positioning. You can see the expected returns from those two asset classes are well below inflation and not necessarily giving you some comfort in terms of the potential returns on offer there. The 6 to 12-month view on global bonds is a little bit more positive. You can see in an environment where potentially a recession plays out and central banks then start cutting interest rates. That's fairly good for bonds. You see some decent capital growth come through in that type of environment. It's one of the reasons why on a 6 to 12-month view, we would want to be overweight global bonds. Similarly, global cash, you can see there, US treasuries at the moment are giving you well over 5%, given US inflation being 3.2% currently. You're getting a real return from cash as well in the offshore space, particularly the US. So necessarily beating inflation without taking unnecessary risk. Global ILBs, we underweight that, especially as I've shown you earlier on that inflation is ticking down. In that kind of environment, you want to be underweight inflation-linked bonds. Global property, it's still currently underweight from a positioning perspective, but the 6 to 12-month view is to upweight that to neutral, largely in view of the fact that global property tends to, follow suit as what global bonds does in that environment, particularly as a recession plays out, but as interest rates get cut. Global property is still relatively attractively valued at the moment. It was one of the worst performing asset classes last year and has lagged global equity year to date, so it's still relatively cheap compared to other asset classes. Right. So that's the asset allocation view. You can see quite constructive on local assets instead of offshore assets. That's one of the reasons why we're currently slightly underweight on offshore. The 6 to 12-month view is to reduce that underweight to offshore and build that up to an overweight over time. In terms of wrap fund changes, if we look at the portfolios of the Jenwil practice, we can see that the flexible income portfolio, there's been no changes made this quarter. We did make some changes last quarter where we dialed up the duration slightly with some of the changes that we made in the portfolio. But for this quarter, we are keeping it as is. In terms of the wealth protector, that's the low equity wrap fund solution. What we did do in this particular quarter was take a little bit more profits on global equity exposure, given the further rand weakness that we've seen now in the month of August. We've reduced some exposure to Net Group Global Equity and Coronation Optimum Growth, and that was to build up the local fixed income, short duration fixed income further in the portfolio. If we look at the General Wealth Creator portfolio, that's the medium equity solution, no changes were made this quarter. Moving on to the higher risk profile portfolios, that being the Wealth Accelerator, that's the moderate aggressive portfolio. In this particular portfolio, we were a little bit more active in terms of the fund movements. We've taken some profits on global emerging market equity exposure by selling down, the Coronation Global Emerging Markets Flexible Fund exposure completely, given the negative outlook for emerging market equity over the next 12 months. We've shifted this to local fixed income and also local equity by increasing our exposure to the Amplify Strategic Income Fund, as well as the Centaur Flexible Fund, which has a little bit more of a growth investing style, which will be a beneficiary of an environment once interest rates start to get reduced. So that's been the main changes on the Wealth Accelerator. In terms of the Global Wealth Accelerator, a similar theme. We've taken some profits on global emerging market equity, given the recent recovery that we've seen this year and also the rand weakness. We've sold half the Coronation Global Emerging Market Fund exposure, given the negative outlook for emerging market equity over the next 12 months, and shifted this to both local fixed income and equity. And we've done this by increasing the exposure to 361 Flexible Opportunity Fund, Amplified Flex Equity, which is managed by ABAX, and then some Top Choice, which has lagged the market slightly this year, but has offered an attractive entry point to upweight that fund, which is SA domestic equity focused only. So hopefully that's given you a good sense of the market overview, the asset allocation view, and then also the changes that we've made to the portfolio. And hopefully you found this session quite insightful, and look forward to engaging with you next quarter. Thank you so much for your continued support, and have a good day further. Bye-bye.